Hi, welcome to Market in a Minute. So, the last 2 weeks, we got a lot of earnings reports, and there were some really interesting reports there, some really good sizzle. So, we want to walk you through those. And then I want to take you through how to create a durable portfolio. So, we have a moderate portfolio in my firm that yields about 6.5%. It's done really well. I'm gonna show you how we put it together and why we do this. So it's a great little portfolio. Market update. So as you know, we've been concerned about two things. One's the yield on the 10-year treasury. So as the 10-year went up to 4.8%, we were concerned it might go higher into the fives. So we did the math on that and concluded that around 5.5% or higher, given the current valuations of the stock market, you could have a 1987 type of event. However, the bond market cooperated. The yield came down to roughly 4.5. We want to see some government spending cuts. So come on, Don, get out there and cut some of that spending. We want to see those bond yields come down. We think that will bring the yields on the 10-year Treasury down as the government right sizes itself. The other big issue is technology. So again, we talked about this last week. The DeepSeek seems to have some real innovation there. The Microsoft CEO called it real innovation. Who are we to argue, right? Um, that's his business, and I think they're a little bit aware of what's going on, how it can maybe save money on terms of their build-out costs and energy. So we think that this may set the stage for having lower capital X spending in 2026 than we're seeing in 2025. So our base case is that it grows a little bit, but it could very well be down 5 or 10% or more in spending next year if this sort of momentum and the cheaper way of doing AI actually catches on. So Microsoft did report, not a great report. The top line revenue growth was about 12%. So a stock that trades at over around 32 times, 12% top line growth, you just can't maintain the valuation. And that's also a problem for Apple, by the way. But anyhow, their fastest growing division, which is their AI division, right? So their Azure division, their cloud division, grew at only 31% versus expectations of 33. So 2% difference, right? So what's the big deal? Well, that fast growing part of their business slowed down. The revenue growth slowed down. So the stock reacted, nicely negative to that. Meta, actually, I was very impressed with Meta. Meta had a very compelling call. Meta has a very good business model. I think Google's business model may be better, but I was very impressed with Meta. They're going to benefit if AI cost decline. So Meta and Google are probably two big beneficiaries. Amazon maybe as well. So Amazon and Google report this week. We'll see what they have to say. Tesla. So Tesla, the sizzle is they're going to roll out robotaxi. So sometime maybe the middle part of next year, they may have 2 million units, 2 million self-driving cars that will be used as taxis. So remember, Google is the other competitor in this group. So Google may benefit quite a bit along this trend as well. So we got to say that Tesla it had a big run up, it's pulled back some, it pulled back to an interesting level. We're watching it. I know this doesn't sound like me, but it may be an interesting purchase. Um, so just in general, the earnings trends have been better than expected. 2 weeks ago, we had a lot of financials report. The financial stocks, um, nice reports, really nice reports. So if you're getting good reports in the financial stocks, that bleeds over into the small cap stocks. So we're seeing signs of this rotation actually occurring, and the market's been rotating nicely this year. Technology hasn't been doing all that great, but the rest of the market's been doing very well. Dow Chemical reported volumes got better, but pricing was weak. They said they're going to cut $1 billion in spending out, and they're selling or part of a division, a plant for roughly $3 billion, and they could sell the rest of it for another $3 billion, private equity oriented. And so they have cash, actually they'll have quite a bit of cash and lower cost structure. Global demand for industrial supplies is very weak. It's been weak now for a few years. That's what's put the stock of Dow Chemical so low. How you buy cyclical stocks is you buy them when they're really low, when things they look like they can't, get any worse, and then that's usually about the bottom. And then when it looks like things are going great, earnings are really strong, earnings are high, the PE multiple is low because the earnings are high, that's when you want to sell them. So we think that Dow Chemical is a nice way of picking up a 7% dividend yield. And if the economy picks up, inflation's coming back, this will protect your portfolios. Innovation is happening kind of everywhere, even in the food area, where Brinker, ticker symbol EAT, they're selling margaritas and burgers, and they're doing a good job at it. And their comp store sales are just off the chart, near 30% growth in comp store sales. Stock's been doing great. So how to play this? Okay, people are aware of Brinker now. Jack in the Box is really cheap, maybe cheap for a reason, but it's super cheap, and it's exposed to being acquired by, in my opinion, private equity. So we don't see Jack in the Box really deteriorating from this level. So we think that is an interesting stock. Now, God bless Larry Ellison, the chairman of Oracle, talking about Grail. Since he's done that, the stock's roughly doubled in price. Grail is the cancer detection blood test that picks up cancer because of the remnants in the blood. I've had it, I took the test, my wife and I did it, we took the test, and, it works really well, test over 50 different cancers. This is the holy grail of cancer detection. Now, you need this. So if you're going to, develop a vaccine or something close to it, you need this to identify where it came from and to be able to do, the recreate it, through RNA testing or DNA testing. So Illumina bought this company for $8 billion. Grail's currently selling for about $1 billion market cap. So we've got a nice profit in it so far. We think even at $1 billion, this stock is cheap. If I was a drug company, I would run to buy this company. I would acquire this company, throw up a double the stock price, get it done, put it in your portfolio, and you've got something that is just impossible at this point to recreate. So looking at the risk management of the markets, around 59.90 on the S&P 500, that's where we want to get defensive. If it breaks through that 50-day moving average, we want to respect that breaking of that important moving averaging it and get defensive. So the rest of the video, we're going to talk about building that durable portfolio, protecting the portfolio, how to protect it in tough markets, how it's just naturally set up to have protection, with that 6.5% dividend yield, and having portions of the portfolio that'll perform well if the market goes down and perform well if the market goes up. So, my moderate portfolio, this durable portfolio, has returned about 11.24% over the last roughly 8 years since it's been around. It's a really nice portfolio. So I'm going to show you how to do this. So in terms of wealth management, just to start, just to set the stage, since 1957, the S&P is up about 10% on average per year. The bond market up 5. So as you know, the 10-year Treasury up 4.5. You're not going to get 5, right? So the best you're going to get, generally speaking, in the bond market is about 4.5%, maybe a bit lower because you're probably going to go shorter and have some corporates in there, but somewhere in that 4.5%. Um, so if you if you look at an allocation of a 60-40 portfolio, so moderate, 60 stocks, 40 bonds, um, historically you would have gotten about an 8%, 8.5% gross return, so not including fees and anything else that your advisor may charge you, but a 8.5% gross return. So we don't think that the 8.5% is very likely because stock prices are high. So if you just own the S&P, you're probably not going to get a 10% return without having a major decline or a decline in the overall stock market. And then your bonds, you're probably not going to get 5. So something maybe in the 7 or maybe 6s is about what you're going to get with the traditional 60-40 allocation. And I'm going to show you how to put this together to get a really nice potential return. So this is a chart, 50 years of 60-40. These are the data points. So you get roughly, here's the midpoint. The midpoint of all this is roughly not quite a 10% return, and then a 10% standard deviation. So you get roughly 8.5% sort of returns, and then the standard deviation of 10. That's not horrible, but we can do better. The whole thing, the real focus to do that is to avoid this downside, avoid these almost 40% drops like he had in 19, or excuse me, in 2007 or 2008, this major drop here. But you want to avoid these. And the more you can avoid these, the better your returns are, and keep it, keep the returns positive. So how to do that? Well, you start by having a roughly a 6% return to start with. So keep that yield in the portfolio nicely high. So just looking over here, this 2022 period blows me away how bad it was. Equities, okay, the equities were down roughly 18% in 2002. Bonds, so what usually happens that we see is that when you have a bear market, it's often caused by the bond market. So the bond market, I think this was the worst year ever, down 13%. But some bonds really cratered, like the long-term treasuries. Treasuries are safe, right? They're not. So long-term treasuries down over 29%. The only thing that held up was cash, and maybe you had some inverse ETFs in your portfolio and protected it. That's what we do. But we want to talk about a portfolio that doesn't have that inverse ETF in it, doesn't have the hedging. So the hedging can cause you to lag in a strong bull market, and it can really help protect your portfolio in a bear market. But this is a durable, we put this portfolio together to be durable without the hedge, having some downside protection in place with that nice yield and some securities that will hold up in a bear market. So think about this. So you might have your money at a large broker dealer, right? That manages trillions of dollars. We don't manage trillions, we manage under $1 billion. So we have the opportunity to be able to move things around. So we're a boutique firm. We can be smart about what we do, a little more creative than the large firms. They can't, because they have to buy big size for all those clients they have. So they talk about owning the belly of the bond market. Why would you want to do that? Why would you want to own the belly of the bond market? You own all those bonds, and you're susceptible to having, a down 13% or more in your bond portfolio. So what we're looking at currently, this is how we're positioned, is we want to own where the elbow is in the yield curve, right? Where's that elbow? So sometimes it's 3 or 5 years out. Right now is the short end. The short end's yielding, a really nice yield on the 30-day treasury, 4.3% roughly, was 5. but it gives you a really nice return, almost equal to what the 10-year treasury is. So why take the risk? Then with some of that money, you can buy baby bonds. Baby bonds are a smaller denomination of bonds. They trade like a preferred, like a stock, usually around $25. Baby bonds, what that we focus on are 5 years and less in maturity, are investment grade, and yield over 8% or roughly 8% yields. So as it goes down the yield curve, as it gets closer to maturity, that 8% really stands out and is really defensive in your portfolio. So if you got some baby bonds and some short-term treasuries, that's going to probably way outperform the bond market this year, unless you get some sort of big rally in bonds, so yields drop dramatically. And then our baby bonds will perform well anyway. So building this portfolio, first thing I do, right? You guys know me. First thing I think about are the negatives. How to protect myself. I always think about how to protect myself. As you know, we hate to lose money. So first thing I think about is inflation on the bond side and recession on the stock side. So on the inflation side, we want some inflation protection. And then if we have inflation, we don't want long dated bonds. So we're not doing that. We're being smart about what we're running. So inflation protection. So we have this tranche here. This is not this is not fixed income. These are equities. So we have a few stocks in here. Some are like Dow Chemical, and some energy stocks. So as the inflation heats up, those stocks will go up in value, probably very nicely, and offset anything you may lose on your bonds because of the rise in interest rates. So most portfolios, the big firms aren't going to have things like that, smart things like that to protect your portfolio. And then on the equities, we have a nice yield in the portfolio to start with, right? And so on the equities, we've got things that may not be highly correlated. So like we own a 1% position in Grail. Now it's 2%. We got a whole 1% move in performance off of Grail this year in that one stock. So we think there's more to come. But inflation has nothing, or recession will do nothing to this stock likely. And then we have things that will perform in a down market. So this is the BlackRock. I think it's BlackRock or Blackstone. BlackRock, a closed-end fund on healthcare, yields 7.7%. This has performed really nicely for us as well. So this is not 15% of the portfolio. We have a whole tranche of stocks in here, some closed-end funds, but some high-quality companies, some food companies. Inflation picks up. We got those will do well with inflation, the food companies, and if the market rolls over, food stocks always hold up really well. So we have some good quality companies in there. In general, in our individual stocks, a company like Google's got that going on, that could rise nicely over time as well. Now, what's really unique, we need some S&P exposure, even though we're not crazy about having so much in technology. But the SPYI is a S&P ETF that writes calls, right? It writes calls in the portfolio, calls and puts. That's what they do. They write it. You actually get the return on the downside of the S&P. It's more modest returns on the upside, but it has a 12% dividend yield. So if the market goes up, it's going to go up, and you're going to collect also that 12% dividend yield. So getting that 6.5% yield in this portfolio, 6.5% yield. If the market goes down 6.5%, okay, I got my 6.5%, I'm even. The market goes down 20, I would expect to be down much less than 20, plus I got that 6.5% dividend yield. So I might be down somewhere in the mid to high single digits, kind of, hopefully that's worst case. So thinking about that, what else do we do? So we put some stop losses on particular securities. Like I'm not going to write Grail down. I'm going to put a stop loss on this. That's the goal anyway. Google the same way. The food stocks the same way. Um, these baby bonds, I'm not worried about them. You know, they'll mature relatively quickly. The closed-end funds, closed-end bond funds, that sort of thing. We have this. We like the mortgage-backed securities. That's the area of the bond market that has highest yield relative to its its history than any other group currently in the bond market. So where you find good bonds right now is as mortgage-backed securities that are guaranteed by the federal government. Dynex owns, this is a mortgage REIT that owns those mortgage-backed securities. Not worry about that in a bear market at all. If housing goes bust, guaranteed by the government, I'm collecting almost 14% on that security. So that's very nice. I do worry about rising interest rates, so that could impact the NAV of this particular stock. So I got some inflation protection in there as we talked. High yield, I don't have a lot, but I have some. Kicks off a nice yield that gives me a little extra dividend. I do it smartly. The BXSL, this is probably the highest quality BDC out there. Really like that one. Not concerned about a recession with that one either. So we put this together with some stop losses in place, securities that can protect you in a down market, but also go up nicely in a bull market, and that nice 6.5% dividend yield. Well, that accumulates over time. That kind of builds my return in. So if you're just in a S&P ETF, you might collect only 2%. So the whole or less. So a 60-40 blend, you get somewhere around a 2% yield on that. So I'm way above that with a 6.5% yield, and I bake that in every year. So that accumulates 6.5% every year. I collect that. And if you're in say an S&P fund and you're down 40, well, you know, it's going to be a hard time making that back up. But I've got my 6.5%. It buffers the downside, and I've got that accumulating over time. It's really a nice way if you're a moderate or conservative investor to do this. Now, if you say, okay, I can scale this up, I can make this aggressive, I can cut these back, you know, I can make this 20 or 25% in these bond-oriented type of securities and put the rest in equities, or I can scale it down. I can put, 40% to make it conservative, 40% in the equities, 60% in the fixed income type of securities. And then you got a really conservative portfolio with even a higher dividend yield. So again, that income really protects the portfolio over time. I can adjust the beta. The beta is probably less than a 60-40 mix in total, how we have it structured. And we have some, stocks that perform probably pretty well in a down market, but also perform well in an up market. So that's our tutorial on how to build a durable portfolio. That's a moderate portfolio. If you have any questions about that or interested in talking further about it, just ping me. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. And if you own Grail, please give me a like.